So welcome back, traders. So by now you should know what is an inducement. An inducement is, let's say you have your structure right here, and this is your potential point of interest. So this is where you want to take a buy from. So price will come down, get close to your zone, and expand, and potentially even breaking structure. So what happened here? Retail traders purchase price here, as seen price was climbing up, or even they could have purchased price right here at this break of structure. So what happened here is liquidity was formed. This is where the stop losses are. This is where the stop losses of everybody that purchased price at this zone right here, anybody that purchased price right here, or whoever purchased price at the break, with their stop losses being right here. So what has to happen is price needs to come back and absorb this liquidity. And that's not the only option. There's also the fake out. So again, a lot of smart money traders, when they do see a break of structure, they would look at internal liquidity. So once they see external liquidity, they would look at internal liquidity. And a lot of traders will take a trade right here. They'll anticipate a rejection right here just for price to give them a micro rejection and absorb that liquidity and go to that initial target. So this is what an inducement is, this phase right here. So here's a basic example of an inducement. What you have here is, if you're looking to sell price, where would your point of interest be? Your point of interest would be, again, buying low and selling high. If you are in a bearish market, you want to sell high. What would be considered as selling high? Selling high would be somewhere up here. Easiest way to determine this is pull out your fib and mark up your expensive, where price is considered expensive, which would be your extreme zones. This would be your premium, and this would be your discount. So if you want to purchase price in a bullish trend, you would be purchasing price right here, or even counter, to be honest. And you should be selling price at extreme zones. Again, I'm sure you can make money selling price at the 50% at fair price or in other zones or whatnot, but this is just the safest. Buying low and selling high. So this would be your extreme zone. Inside of this extreme zone, you can narrow it to an order block. You have a supply order block right here. So you would be looking to sell price right here. And where is your inducement? The easiest way to do it is just look at a swing beneath your point of interest. And obviously you can see this swing and think of it like this. Not only that this swing, this is where price was sold. So somebody sold price right here, sold price here, sold price here, and their stop losses are right here. And again, that's not the only function. So first, let's mark up this external liquidity. So this is where the stop losses are. We can anticipate this to be absorbed. And not only that, look at it from a structural standpoint. So you're working within this macro structure, but from a micro standpoint, you do have a break of structure here. And what do a lot of traders do? Especially price action traders, when they see a break of structure, they instantly look at what broke that structure and they would mark up their extreme zones like this. And a lot of people who don't even mark up their extreme zones, they would just wait for a break of structure and mark up the order block. So this would be the order block. So again, you have traders taking this sell as well, with their stop losses being above the swing. So this is a 2-in-1 combo. So not only are we taking the stop losses of everybody that sold from this swing, some traders are entering the trade right here. So this is the purpose of an inducement, inducing you into taking an early position where your initial point of interest and where you should be looking at is right here. So now that you know basic inducement, the inducement we're going to cover in this lesson is going to be more compressive. So we're going to look at inducement responsible for breaks of structure. And what I mean by compression is, let's say price is moving like this, and out of nowhere you see price compress. Movements get a lot of smaller and it's operating on a different time frame. So if you look at it from a auction theory standpoint, the auction changed time frame. So this would be price operating on the daily, let's say, and in this specific point, price operating on the 4-hour. And what we're going to look at is we're going to look at the compression responsible for the break of structure. So what happens a lot of times is, let's say you have a low, price makes that major low, and then as price makes the high, what you would have is order injection responsible for that break of structure coming from a peak. So let's say that peak could doesn't really have to come from a specific point of interest. So that could be a previous, let's say, a previous order block, a previous macro order block, or it could just be external liquidity where price absorbed liquidity and so on. It doesn't have to be specific, but when you see a swing, a major swing, and price is shifting to the downside and breaking that structure, confirming that this is a swing high, understand that orders were injected to confirm this major swing. And a lot of times it happens in this little swing. So this would be our inducement. We're looking at this inducement responsible from coming from a major swing and breaking a structure. So what caused this structural break to confirm the swing is this order injection. And this order injection, this would be your inducement. And by this being your inducement, you do understand that price will eventually sweep. Now, this is where it gets important, right? We're not saying that price is going to sweep the zone and drop and continue the trend. That doesn't really have to be the case. What we are saying is price will sweep the zone. For how long? I'm not sure. Nobody knows. It's the market. The market is going to do what the market wants to do. It could be a micro sweep like this, sweep that liquidity and change trend, or it could be a sweep and for price to continue the trend. Either way, what we're looking for is that liquidity sweep coming off this inducement. And why this inducement? Because this inducement is responsible for locking in that swing. And before we go to the next example, this is something I really need you guys to understand. There's two types of compressions. You have compressions that are responsible for breaking structure. So let's say this is the structure, price rejects, and there will be a compression responsible for breaking that structure. This is where the orders were injected to commit to that break. So this is one type of compression. And what do you do with this compressions? You wait for that sweep. This is an inducement. Price should absorb this liquidity. Can't say will because it doesn't happen every single time because again, this is the market. It's a game of probabilities, but it should absorb this liquidity. Now you have another type of compression, compressions that happen at peaks. So that happens at major swings. So let's say this is the trend. This is the trend and the trend changes. And at the bottom here, where a reversal happens, price starts compressing. As price compresses and expands. You're not expecting this liquidity to be swept. When it comes to this type of compression, you are looking for a rejection. And we're not going to teach this in this lesson, but when this is the form of compression, you will more than likely get a rejection, not a sweep. You get a rejection. So again, the one that's responsible for a break of structure. And I know this is complicated and we'll get to it in this next example, but this is where you're looking for a sweep and this is where you're looking for a rejection. So a quick side note is don't look for perfection. I mean, ideally what we would like to see is before price break structure, for price to compress or at least give us that one swing. And the thing about that one swing is, let's say for breaking structure, it's simply one swing. That one swing on a lower time frame is multiple swings, therefore a compression. So yes, ideally we would like to see something like this, but let's say there is times where price breaks structure without really forming it. But what happens next? Price will break structure and will come revisit that zone, grab more internal liquidity. Where does price grab that internal liquidity without going into too much details? You would have something like this where previously was a supply zone. That supply zone turns into a demand zone and you will have price grabbing that internal liquidity, right? And this would be your inducement swing now. That swing revisiting that range to expand price needed to grab more orders to continue with that trend. So it's one of those two again. It could be this could be order injection or it could be this. Since price didn't form any internal liquidity before expanding, price will come back and form that before going. And that's just how price action is priced in. It will be one of these two. So let's look at this example. So we're going to ignore context and we're going to strictly look at inducements. We're going to look at compressive inducements. So here we have a break of structure. What is responsible for this break of structure? You can make a case that it's this order injection right here. And you can make a case that this was a compression as well that pushed price. This was a compression as well that pushed price. So in this case, you will mark both levels. And if your question is, how would you know exactly which one is which one and et cetera, it's a game of probabilities. This is the market at the end of the day. To know exactly specifically which one will work, which one we don't, one of them could work or both of them could work. Is is based on probabilities. Me personally, I would look at the higher option. I would look at the option closer to the major swing. So what are we expecting this levels again before we start playing? What we're looking for a sweep. We're not saying that price is going to sweep the zone and drop 100 pips, 100 pips or whatnot. We're just saying that price will sweep that liquidity and we are not getting a rejection within this level. So price is not going to come up here and reject of this level. Again, it could happen, but probability wise, it's unlikely. We are looking for sweeps. And we're just trying to see how often will price sweep these levels. So here, price absorbed this liquidity, and we could potentially head for a sweep. And while we at it, let's look at this major swing right here. We didn't have anything pushing price to break the structure, but we have a structural confirmation. So once price broke structure, price came back, grabbed more internal liquidity to push up. So this tells us that this would be a level of liquidity, and this would be our inducement zone. So while we're still here, we're waiting for that sweep. And we had our sweep. So this would be your basic purge, right? This would be your basic purge, right? It's absorbed liquidity and came back inside the range. Again, we don't know how deep price will drop, but we do know that this reversal was coming. So, and price dropped pretty deep. Where are we looking at for our next inducement? At this zone. Price getting close. Absorb absorbed that liquidity by almost 1 point, 1 pip, and reversed. So now where are we looking next? You could look at it from a micro structure standpoint and look at what release price below the structure. What release price below the structure would be this right here. So you could get like a really micro sweep. And why really micro? Because this is microstructure. We're still looking at the macro structure. So you could get something like 10 points out of a move like this. And you had your sweep right here. But I don't expect this to continue for a while. So so to not confuse you guys, let's focus on the major structure. Okay, we have no point for this anymore. And let me make this bigger. What happened? Price absorbed that liquidity. So again, this is inducement. Let's carry on. If we're looking at it from the bottom structure right here, what release price? We're looking at the bottom sweep. So this was previously used. This was previously used. The only other option that we can look at here is we can look at this break of structure and where is the compression? The compression is right here. This entire thing would be the compression. So this is where your inducement is. And I get it, guys. This might be a little bit confusing for the first time, but the more you practice, the more it makes sense. So if this is the compression, we are looking at this to be our liquidity point, and this is where we can expect that sweep. What happened here? Price swept this liquidity, went to internal liquidity, and expanded. So now let's delete everything. Let's look at our potential sweep. A potential sweep could be this break of structure right here. And now you're going counter trend because look at the previous macro structure. You had a break of structure to the upside. So this would be extremely risky. But we're doing this just to train our eyes to look for these inducements. This was a break of structure. Where's that compression? That compression is right here. So by this being the compression, this compression right here, this would be our liquidity. And again, since this is counter trend, this could be simply a 5-point sweep for price to continue to the upside. And that's what it was probably potentially. So since we're on the 4-hour, you can see price came up here and dropped down. This is more than likely the 10 points. And that's exactly what it was. And why was this not significant? Because you are going counter trend, going extremely counter trend at the extremes. You should never sell counter trends, especially at extreme points. So let's carry on. So what happened here? Break of structure, break of major structure. What forced that break of structure? You can say this compression. Price, it was a sell into a buy. So this is your compression and this would be your inducement. Where could your point of interest be? Again, it could be something like this demand zone, or you could pull out your fib and look for an extreme zone. Either way. Break of structure, but this is a counter trend, so you want to be careful. So you had a break of structure right here. What forced that break of structure? It would be this compression, this last swing high. So this would be your inducement. Hopefully everything is starting to make sense. And we can make another lesson on how to fully optimize this. But again, this is just simply for you guys to be able to read price. You had a sweep right here, dropped a few points, and now reversed. What did price interact with? Price interacted with extremes. So price swept that liquidity to interact with extremes. And how this does help is it will stop you from making these silly type of trades it'll stop you from making these silly type of trades where you would think that price is going to reject from this zone. Let's carry on. What do we have here? We have a break of structure. We have a break of structure. What happened prior to that break of structure? This was the compression. That's selling to a buy. If you go on the lower time frames again, you would see it clearly. It would look like this. And your inducement is right beneath that. So you are anticipating a sweep around here. So again, if price gets to this zone, you are not taking a buy right here. You are not taking a buy right here. You're looking for that sweep. And if you are looking to take a buy somewhere here. This is just nasty price action. So this is just nasty price action. Nasty, nasty price action. Let's move this right here. Move this right here. You had another break of structure. You had a break of structure. What push price to break that structure was the sell into a buy. That sell into a buy. This would be your inducement. And this does happen where sometimes price just ignores, does not visit your inducement for a while, but eventually price will come visit these levels. And even if a new bearish trend start, you would see something like this, right? You would see, let's say a bearish trend starts, a whole new bearish trend, you'll still see these sweeps. Even if price doesn't shoot up all the way, you would still get these sweeps on the way down. That's just how it's priced in. What do we have here? We have a break of structure. We have a break of structure, and prior to this, you had a break of structure right here. I would choose this one as this was the most recent. What push price? What push price is this candle right here. When you have wicks on both sides and an aggressive wick, that means there was buying into selling here. I did a lesson on this. You guys could always go in the archive and look at my previous lesson. So this would be your inducement. Let's delete. Actually, let's make this a line. And let's mark up our inducement. So now watch on the way down, even though now this is a counter trend, now taking trades to the bull side would not be efficient, but you would still see how price reacts to these compressive inducement swings. So you see, at a quick sweep and price reversed. What's our next target? Our next target is right here. Just want to see one more example. Okay, what do we have here? This compression push price. So this would be, again, what happened? Sweep. Price did not reject from this zone. This was a sweep. And so on, so on. I explained this much greater in my on my website where we went into details when it comes to this. But for now, what I would advise you as an upcoming trader, start marking up these zones and just look at how price reacts to these levels. And a lot of times it's extremely, extremely accurate. Actually, let's just go for one more example. We're in too deep now, anyways. Okay, price rejected. What do we have here? We'll force price to break this structure, this compression here, potentially get a sweep right through. I would say, yep, yeah, you'll get a sweep and a potential rejection somewhere here. Let's see. Okay. So we had that sweep. You go on the lower time frames, see that price quickly. It's almost like price had to come and sweep this liquidity. And again, guys, if you guys enjoyed this lesson, make sure you let me know in the comments and we will make a part two with a little bit more detail.